bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the June 3rd, 2025 podcast. I'm here today with my partner, Tony Grappone, and this is our latest installment in our monthly Renewable Energy Tax Credit Finance series. We do have a playlist of all episodes in this energy series on YouTube. This is our 18th installment of that series. And today's episode is a follow-up to an episode that we aired last year on prevailing wage and apprenticeship requirements for renewable energy tax credits, sometimes called PWA requirements. Now, our regular listeners may be wondering why we're so focused on prevailing wage and apprenticeship requirements when a bill has been passed by the House that would be very detrimental to the renewable energy tax credit community. Now, we do expect the Senate to relax some of the House provisions. And if you want to know more about how disastrous the House bill would be to the renewable energy community if it were to be enacted as passing the House, I'd encourage you to listen to or watch the podcast that Peter Lawrence, our Chief Public Policy Officer, and I recorded last week. I'd also encourage you to review our various blog posts. And I'd also encourage you to join, if you're not already a member, of the Renewable Energy Tax Credit Working Group, which Tony leads, along with Peter Lawrence and our public policy team. And beyond that, I'd encourage you to do advocacy on behalf of renewable energy tax credits, particularly with the Senate Finance Committee. That said, we do expect there to be a robust investment tax credit market for several years to come. And to that end, we thought it was important to revisit the PWA, or prevailing wage and apprenticeship requirements. And today's episode will go a little bit deeper on practical strategies to ensure you're complying with those rules. We'll share some useful tips and strategies, as well as some traps to avoid. Now, before I proceed, I wanted to share some background as to why PWA compliance is so important. And this is a bit of level setting. And please bear with me if you're very experienced and already know the answer to the question. Now, in the renewable energy space, our less frequent listeners may be thinking of the investment tax credit as a 30% tax credit. For years and years, it was a 30% tax credit. Then it decreased a little bit each year as it was phasing out, down to 26%. And back in 2022, the Inflation Reduction Act, as a technical matter, actually reduced the then 26% credit down to 6%. Now, obviously, we don't talk about a 6% credit, we talk about a 30% credit. And that's because the Inflation Reduction Act also enacted provisions that increased the credit rate to 30% if you satisfied certain prevailing wage and apprenticeship requirements. And as a consequence, I mean, Tony, have you ever seen a 6% transaction? No. Tony's shaking his head no, in case those of you that are listening and not watching on YouTube. So everyone thinks about it as a 30% credit, and everyone thinks about it as you have apprenticeship and prevailing wage requirements that you need to satisfy. And to that end, Novogradac, with Tony's leadership and many others at Novogradac, we built a line of services tailored to satisfy investor due diligence requirements with respect to the PWA requirements. And Tony and his team, as you know, work with many renewable energy developers and investors. And Tony will share his various tips on do's and don'ts for PWA compliance. Now, we have a lot we want to cover today. So if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's always great to be here with you.
And it was great to see you in Chicago a few weeks ago at Novogradac's 2025 Spring Renewable Energy Tax Credit Conference. And, as you know, the conference kicked off just one day after the House Ways and Means Committee released their markup of the House Reconciliation Bill. So there was no shortage of hot topics to talk about at the event about the damage the House bill would cause to clean energy.
Yeah, indeed. I'll tell you, a lot of people come up to me at our renewable energy conferences, Mike, and they say, "How do you guys time your events so well?" Okay, so for some reason, I don't know how we do it, but coincidentally, we oftentimes our renewable energy conferences happen to take place at a time following some sort of major election or policy enactment or what have you, something that really impacts the industry from a legislative matter. And so, yeah, the Washington Report panel that you moderated, as well as that policy discussion that you moderated with Jason Grumet, I mean, those conversations were just so timely and had everybody on the edge of their seats. And somebody came up to me and said, Mike's turned into like the E.F. Hutton of tax credit policy matters.
I think we're both
So-
dating ourselves with that reference.
Right. We'll see how many
The fact that
listeners.
you used it and I got it.
Exactly. So, but no, the conference was an overall success. The timing couldn't have been better. And I think a lot of people felt, all the attendees that were there said they were so glad to be there at that time to get all that excellent perspective on the House bill, as it first got released. So great timing.
Thank you for that. And, one thing that actually, before I ask you that question, first give a quick refresher on the prevailing wage and apprenticeship rules, and then we'll go down a little bit deeper into each of those.
Yeah, great. Yep. So I'll cover this from a high level. As you pointed out, many of our listeners are sort of already familiar with some of the PWA rules, but for those of you who are new, and there could be some folks here that aren't that familiar with it. And as we get through this podcast, I'll reveal some folks that this podcast really may appeal to, and those folks really may not be familiar with these rules at all. And so it does make sense to kind of cover them, at least from a high level. All right. So first off, as you alluded to, the PWA requirements, they first came into for renewable energy tax credits. They were never an issue until the Inflation Reduction Act was passed. Once the IRA was passed, that requires taxpayers commencing construction on qualifying facilities after January 28, 2023, and facilities that are over 1 megawatt AC, those facilities are subject to this PWA criteria. So now, if you commenced construction before January 29th, 2023, or if your facility is under 1 megawatt AC, then you're deemed to satisfy the PWA rules. Okay. Now, these days, we're not coming across too many facilities that commence construction before January 29th, 2023. And we don't see too many facilities that are under 1 megawatt AC. So, most facilities are subject to these rules if they want the higher tax credit percentage. So, but big picture, if you're subject to the PWA rules, then taxpayers are required to pay prevailing wages to all laborers performing construction and or alteration of the facility. And they're also required to use apprentices for a minimum percentage of the hours to construct the facility. Now, the PWA tax rules, they're provided for in final Treasury regulations that the IRS and Treasury published last June. And then for nuanced apprenticeship rules, those rules can be found in the applicable apprenticeship program guidelines for whichever apprenticeship program you're enrolled with.
Great. Thank you for that overview. And there's probably a listener or viewer or two that are wondering, while we're not going into depth on this podcast about the House bill and the damage it would cause to the clean energy community, probably wondering, does the House bill change at all the PWA requirements? There was some talk that maybe the PWA requirements would be changed by House and or Senate Republicans.
Right. So leading up to the House bill being passed, there was some speculation that maybe that House bill would change the way the PWA rules are, whether they apply at all or how they're enforced. We haven't seen that in the House bill. Maybe something does happen on the Senate side, but as of now, we don't anticipate any changes to the PWA rules with respect to these tax credit percentages.
Great. Thank you for that. Now, when we talk about prevailing wage and apprenticeship requirements, let's talk about them. They're two separate requirements, but both need to be satisfied. And before I ask you about the various services that you provide in each of those areas, can you first talk about when you recommend that you get engaged to provide the various services you provide to avoid failing to satisfy the requirements or committing pitfalls?
Yeah, great. So we have a bunch of PWA engagements in progress right now. We have many where we've been hired at the end of construction. We have several where we got engaged midway through construction, right? And then we also have several where we got engaged before construction commenced. Now, if possible, I always recommend clients engage us before construction commences, because if we're able to perform, our analysis as construction progresses, then we can identify potential issues earlier on, which can then help clients kind of course correct. And if they can course correct timely enough, they can avoid costly, penalties and corrective payments that may come up if we're engaged kind of late or after construction's done.
And that's certainly a theme of this podcast and all the various areas where we provide services. Earlier is always better. And the longer you wait, the harder it can be to correct issues that get identified. That being said, you definitely want to identify them as soon as possible, even if it's late in the process, because time always allows. The earlier it's found, the greater options you have. So let's start with prevailing wages, and then we'll talk about apprenticeship requirements. So let's start with prevailing wages and tell our audience what the services are that you provide to help developers comply with various investor due diligence requirements and get a certain level of comfort as to their own compliance.
Great. All right. So first off, I'll just note that the IRS doesn't require a third party to review a prevailing wage and apprenticeship compliance profile. That being said, most investors in the marketplace do, as a condition precedent to financing, require a third party like Novogradac to perform diligence to analyze the PWA profile of a facility before they'll fund money. And some tax insurance providers can also require that, or tax credit buyers.
And I would just note that's much like historic tax credits. Investors will require a cost certification. The legacy tax credit, there is one required for state agencies. So there it's a state agency requirement as well as an investor requirement, but it's quite common across all the various tax credits for investors to identify these cliff effect sorts of issues and want some degree of external assurance.
Exactly. That's right. So we're usually doing this because an investor requires it. We do have some situations where just the developer is building a project on their own, doesn't have an outside investor. They're just kind of paranoid or nervous, or they just want to make sure they've got their ducks in a row. So they just hire us without that sort of investor requirement. Anyway, just the big point is it's not an IRS requirement for third-party diligence. It usually comes into play because of a financing requirement. All right. So yeah, now let's unpack that a bit. I like how you focused on prevailing wages. So that's how we approach it. We sort of think of prevailing wage testing as separate from the apprenticeship style testing. So when we get engaged to help a client, we're usually getting engaged pursuant to what's called an agreed upon procedures engagement. That's a classic type of engagement that investors like when they're looking for some third-party help to analyze some type of tax compliance matter. Okay, so we perform the service pursuant to an agreed upon procedures engagement. And then for prevailing wage testing, what we're doing a lot of there is we're looking at what's called certified payroll records. Okay, we're taking certified payroll records from the taxpayer that owns the facility, and oftentimes they're outsourcing that work to various contractors and subcontractors. But anyway, we're looking at the certified payroll records from the employers of the laborers that are doing the construction of the facility. We're looking at the hours they worked, their job classifications, pay rates, and then we're comparing the amounts that they were paid to the minimum amounts that they were required to be paid based off of the prevailing wages as published by the Department of Labor. Okay, so we analyze what they were paid against, and then we do a recalculation of what the minimum they were required to be paid during any pay period. And a pay period is usually a week. Okay, and so we'll do that for every laborer, for every pay period of every contractor throughout the whole entire construction period. And we will identify if we observe any situations of corrective payments necessary. A corrective payment would be necessary if in any pay period you had a worker that was underpaid compared to what they were required to be paid.
So what are some of the common issues? You just mentioned one there. If you identify a worker being underpaid, are there other issues that you commonly confront as you approach this analysis?
Right. Yeah, exactly. So a common issue we can encounter is with respect to clarity on the certified payroll records. Okay. Couple of examples. One example might be a job classification that isn't particularly clear or explicit in terms of what their required pay rate is. That's one example. Another example, a classic example, is with respect to fringe benefits. We see some certified payroll records where the fringe benefits, where all fringe benefits are included on the certified payroll record. And when I say all fringe benefits, I'm talking about cash fringe benefits that are paid directly to the employee versus non-cash fringe benefits such as pension payments. Okay. We've seen certified payroll records that reveal all that information, and we've seen certified payroll records where some portion of the fringe benefits are paid outside the certified payroll records. The issue that can create is if we're looking at the certified payroll record and we're using that as the documentation as far as what the laborer was paid, well, if that certified payroll record omits any portion of their compensation, like non-cash fringe, then that can lead to us getting the impression that maybe they were underpaid and need a corrective payment. And so oftentimes we'll do our analysis, and if we start to see a trend of perceived underpayments, we'll reach back to our client and say, are we getting the full picture here? Is it possible you've got some other payments going to this labor that's paid outside the certified payroll records? So those are probably two examples. Lack of clarification with job classifications and certified payroll records that don't include some portion of the laborer's compensation.
So let's talk about the consequences of failing to qualify. I mentioned earlier that a developer needs to comply with these requirements in order to get the 30% credit instead of 6%. But you've already implied in your answers that the consequences of failing to qualify isn't necessarily that you have to claim a lower credit. It's that you have these payments that you need to make. So explain the consequences of failing the prevailing wage requirements.
Right. So let's imagine that, lo and behold, there was an actual underpayment of a laborer during any pay period during the year. If that happens, then the taxpayer is required to make a corrective payment to that laborer. And let's imagine they do that. If they make that corrective payment timely, they're still in compliance. They're still entitled to the 30% ITC. And if they make the corrective payment within certain time limits, then they can also avoid IRS penalties. Now, let's imagine they make the corrective payment, but they don't discover the corrective payment soon enough to avoid IRS penalties. Then they can end up in a situation where they're not only making a corrective payment to the laborer, but they're also making a $5,000 IRS penalty payment plus interest. And so that time window is very important. The IRS allows you to avoid that IRS penalty if you make corrective payments by the 30th day following the quarter end. So if we're talking about Q1 of 2025, if you discover a corrective payment and you make that corrective payment on or before April 30th of 2025, then you'd avoid the $5,000 penalty. So that's another reason why if a firm like ours is involved earlier on and we're monitoring the results as construction progresses, we can help identify potential corrective payments so they can be made in a timely fashion and avoid costly IRS penalties.
And 5,000 per failure?
Great question. So it's per laborer during the calendar year. So, for example, let's say you had John Doe was underpaid $1 in every pay period during the year. It would be one $5,000 penalty. Now, let's imagine John Doe was underpaid one pay period for $1, and Jane Doe was also underpaid $1 in one pay period. Well, now you have two $5,000 penalties, one per worker.
Great. Thank you for that. Anything else you want to say on prevailing wage, or should we turn to apprenticeship?
That's sufficient for now. We can turn to apprenticeship.
So let's go to apprenticeship. Please share with our audience some of the work that you do through an AUP to document compliance with apprenticeship requirements.
Okay, great. So with apprenticeship testing, the penalties that come into play for apprenticeship, it's not really with respect to how much the apprentice was paid. It's more about the hours they worked. So with apprenticeship compliance, the taxpayer needs to ensure that a minimum percentage of the total construction hours were performed by apprentices. Okay. Now the apprenticeship compliance testing is performed on a daily basis. You remember when I talked about prevailing wage testing, I was focusing on amounts paid per pay period, which is per week. When you get into apprenticeship testing, that's a daily test. And what you're looking at there is you're looking at the number of hours an apprentice worked, and you're comparing that to the number of hours that there was a journey worker on site to provide adequate supervision and support. Okay. Now, if you have a situation where an apprentice worked hours and they lacked the requisite journey worker supervision and support, then those hours where the apprentice worked without being adequately supervised or having access to adequate supervision, those hours cannot be counted towards your apprentice hours for meeting the minimum percentage test. And this is where, when we see this is the biggest issue we see when we do PWA testing in general. If you have an apprentice that worked without adequate journey worker support, those hours are now recast as hours subject to prevailing wage payments. Okay. And so I have never seen a state apprenticeship program that requires apprentices to be paid as much as prevailing wages. They always, in my experience, the apprentices can always be paid at lower rates than prevailing wages. And so an example would be the state apprenticeship program might require a taxpayer to pay apprentices $30 an hour. Okay. Now, if that same apprentice was a journey worker, the prevailing wage rate per the Department of Labor might be, say, for example, $50 an hour. So if an apprentice goes out to the site and works 8 hours that day, now you had a journey worker that went out, started the day alongside the apprentice, worked until noon, but then let's just imagine the journey worker got sick and had to go home, but the apprentice continued to work the afternoon, another 4 hours. Well, those 4 hours in the afternoon, the apprentice can't be paid just $30 an hour. They now recast for payment purposes. They're required to be paid the prevailing wage of $50 an hour. This is a classic example of where a client or a taxpayer didn't realize that the journey worker went home early and that a corrective payment's now needed for that apprentice. That's a situation we see get discovered too late, too often. And so the most common scenario that we see triggering corrective payments is with respect to apprentices that ended up getting recast as a journey worker for required payment purposes. That gives rise to a corrective payment, as well as, if it gets discovered too late, an IRS penalty. Okay.
Yes, that's very interesting, and all the more reason to be looking both at the same time, looking at it at the beginning.
Definitely.
So these situations can be avoided. So what are the consequences of failing to qualify for the apprenticeship or with the apprenticeship rules?
Great. All right. So with apprenticeship, so we've talked about the IRS penalties, the $5,000 IRS penalty per worker. That comes into play when a journey worker is underpaid or when an apprentice got recharacterized as a journey worker for required payment purposes. Okay. But now let me talk about just the apprentice penalties themselves. Okay. You've got two types of apprenticeship penalties. One is what's called a non-participation penalty. What that means is if you're an employer of laborers doing work on the site and you're required to enroll in a registered apprenticeship program, but you did not actually enroll in an apprenticeship program, then you're deemed to not comply with the participation requirement. Okay. And so when are you required to participate? If you have 4 or more laborers performing work on site, you're required to use at least one apprentice. Okay. So If you have 4 more laborers, you didn't enroll and you didn't participate, then you're subject to a $50 per hour penalty. And there's a formula that I could talk you through, but it's a bit involved, so I'll skip that. But there is a formula. Okay. The second type of apprenticeship penalty is pretty simple. The taxpayer is supposed to use apprentices for a minimum percentage of total construction hours. If you commence construction in 2024, that's 15%. Okay. So what we do is we do this analysis where we add up all the construction hours performed during the construction period. We multiply that by 15%. That tells you your minimum, target to get of qualified apprentice hours. And at the end of the day, if they fell short, they pay a separate $50 per hour penalty for the shortfall in hours. Okay.
Yep.
And so we've seen situations where a client cut it too close. They were just at the 15% sort of threshold. However, they didn't realize they had a few situations where the journey worker went home sick, so to speak. Okay. And then that kind of dropped them underneath the minimum bar.
Got it. Is there a recommendation that you give to clients to say, well, don't cut the 50% too close? Is there any sort of standard cushion, or what's your general advice to clients with respect to that 15%?
Yeah, I definitely recommend they build in some. When we see, add like 5%, something like that, like give a little bit of cushion there. Assume that you'll have some scenarios where the journey workers just won't be able to provide adequate support in certain days based on extenuating circumstances. So just kind of round up a bit there. The other thing they can do is, again, if we get involved earlier on, we can help monitor how they're doing in terms of like reaching their target.
Right.
And so when we're engaged earlier on, we'll ask them for their total budget of construction hours. And so every month we're able to see how close they're getting to meeting their target. And if we observe that they're like really far behind, we can let them know that you have a lot of catch up to do here on the apprenticeship testing.
Yeah, it seems like the general approach would be to not get yourself, as you're known, to not get yourself in that situation, and ensure that you have an adequate ratio of journey workers to apprentices, so that if one journey worker
I'll give you another example too, because oftentimes you have like an EPC. An EPC is synonymous with like general contractor in the real estate world. So you have like an EPC, and then the EPC will sub out various tasks to a variety of subcontractors. Okay. Some subcontractors might represent to the EPC. They'll say, look, we don't anticipate having 4 more laborers, so we don't have to use apprentices. Okay. But then
lo and behold, I knew where this was headed.
They add that 4th or whatever. The other thing too is there is what's known as a good faith effort exception. So if you're a subcontractor and you're located in an area, if you reach out to the apprenticeship program, you say, we're an electrical sub, we need apprentices. Do you have any? Please let us know. If the apprenticeship program writes back and says, thanks for reaching out, we don't have any apprentices, then that qualifies for what's called a good faith effort exception. Okay. But to really meet the criteria of the good faith effort exception, you're supposed to reach out to them in a certain time frame, in a certain manner, include specifics about the facility. And so one thing that we'll see is an EPC will say, XYZ subcontractor told us they have a good faith effort exception. Okay. And we'll say, okay, wonderful. We'll need to, can they provide the documentation? And then when we see the documentation, we've seen situations where that subcontractor reached out to the wrong apprenticeship program, didn't include the criteria, asked too late. Anyway, a variety of things where they don't actually check all the requisite IRS boxes in terms of meeting the good faith effort exception. So that can also, you might have an EPC that just assumes, oh, my subcontractor met the good faith effort exception, so we're all good here. And then lo and behold, they do not.
And what percentage of projects would you say rely on that exception, and how do investors feel about that exception versus documenting compliance with apprenticeship rules?
Sometimes if you've got a facility that's located in a particularly like rural area and you've got a well-organized EPC or subcontractor that timely reaches out and so forth, then that good faith effort exception can really be a bona fide good faith effort exception. What we find though is you might have a subcontractor that almost every facility has some small sub where they only had, a few workers or whatever. And so they're not required to use it because too few laborers, or you'll have at least one sub that claims they reached out to get a good faith effort exception. You're gonna encounter it. And it just comes down to the quality of the paperwork and the manner in which they shot it out.
No, thank you for that. So, Tony, I think we've done a good job of discussing the prevailing wage and apprenticeship requirements and the services that you provide, along with encouraging prospective clients to engage us very early in the process. Anything else you want to share before we bring the podcast to a close on this topic?
No, I think we've covered a lot. I mean, we do anticipate, I did a webinar on PWA last year. We anticipate doing another follow-up to that webinar probably this summer. And so if you're interested in a webinar, feel free to reach out to me and let us know some topics that you'd like us to include in that webinar.
Great. Thank you, Tony. I will include your contact information in today's show notes. I'll also include links to the podcast that Peter and I recorded last week about big, beautiful bill that came out of House that's now in the Senate, and some of the adverse effects it would have in the rural energy space, which we expect to see changes in the Senate before such a bill is enacted, if it's enacted, as well as I'll share information about the renewable energy tax credit working group, as well as some link to some blog posts about the bill. And then also we'll include a link to that webinar from last year for those that are interested in that. With all of that said, Tony, you kicked off a off-mic section where we get to shout out an industry colleague. And I really enjoyed that feature. So thank you for that inspiration.
You're welcome.
This week, who's your industry shout out?
Great. So sometimes I give the shout out to somebody in the industry outside the firm, and sometimes I shout out somebody internal. This time I'm going to give a shout out to somebody internal. It's a principal here at Novogradac. His name is Nathan Barrett. He has taken a very active role with the prevailing wage and apprenticeship agreed upon procedure engagements. He's been a big help. He's a subject matter expert. And so feel free to reach out to me, of course. I gladly talk to you about your PWA engagements. I love this kind of stuff. So I'd love to hear from you, but also feel free to reach out to Nathan Barrett directly.
Excellent. And with that, I'll give a shout out as well to Nathan. Thanks for all your work in this area, all the work you provide, all the service you provide to Novogradac clients. And I'll include Nathan's contact information in today's show notes as well. So thank you, Tony. And to our audience, I'm Mike Novogradac. Thanks for listening and/or thanks for watching.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.